Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. If you could do me one quick favor, if you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Also, registration is now open for our next event, the Planet MicroCap Showcase, taking place in person in Las Vegas at the Horseshoe Hotel and Casino, formerly Bally's, on April 25 through 27, 2023. Expect 3 days of networking, company presentations, one-on-one meetings. In short, a lot of fun. If you follow our community and especially invest in microcap stocks, you're not going to want to miss this event. Expect more announcements on speakers and who may be there to pitch a few names, as well as presenting company list. To register and attend, please visit www.planetmicrocapshowcase.com. See you in Vegas. As of Sunday, January 8th, 2023, China has reopened its doors to travelers. In the previous few months, while the rest of the world has gone back to pre-pandemic guidelines and everything has opened up, China has remained on very strict lockdowns. And from an international business perspective, folks were wondering, what are we supposed to do about this? Will China ever reopen? If so, what will the new restrictions be? Also, how do we think about China within the international business community when you compound lockdowns with their association and allegations of supporting Putin in the Ukraine war and the crackdown on Chinese tech companies? Nevertheless, China has reopened, and I wanted to put this news into context as some institutions start to look at investing overseas to park capital if the U.S. is to go into a recession. To help me answer some of these questions, I invited on Michael Fritzell, editor of Asian Century Stocks. Michael is a Swedish citizen who's been living in Asia since 2009, and he currently resides in Singapore and has been investing in Asian stocks since 2008. In our discussion today, we discuss the China reopening, consumer trends we should be looking at in China with the reopening, non-Chinese companies that sell product to China consumer base, investing in non-China-based Asian companies, and what this all means for microcaps in general. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Michael Fritzell. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Michael, thank you for joining me today. How are you doing?
Well, thank you so much. I'm doing well.
All
How are
right.
you?
Well, just making it. It's a monsoon here in LA. So we're just making it through. But again, thanks for jumping on here today. You actually, for the folks that are just listening in, Michael actually just recently participated at during our Stock Pitch World Cup on Team Asia. So, Michael, thanks again for doing that. And I invite everybody listening in or watching to go and check out and listen to his pitch, because we're not necessarily going to be doing any kind of stock pitch today. I really wanted to cover some of the more recent news. As folks are listening in, Michael is the editor of Asian Century Stocks. He just published an article. We're recording this on January 4th. So as of recording this, it was about 18 hours ago, about China's borders reopening. That was very much in the headlines last year, how China locked down again, like in really intense way. So wanted to start off with getting a better understanding of what this means. Are they fully reopening, and what this means for both microcaps and for the broader market? So Michael, let's dig in.
Yeah, I'm happy you brought that up, because this is a topic that I feel very strongly about. The fact that China's COVID-19 policy has just done a 180 shift in the past 2 months or so. And the ramifications for Chinese equities, or really like more broadly as well in Asia, are so positive. And I think people aren't really speaking about it in the proper way. I guess there are a few parts of it. One part is, of course, that the COVID policy has basically shifted. They've taken away a lot of the restrictions, including testing, and also you're allowed to travel within China. And now, from 8th of January, we will see the border reopening as well. So no quarantine when you get back into China. So every kind of restriction that we've had in China for the past 3 years in terms of COVID-19 has basically been taken away. And as far as I can see, that's extremely positive for many Chinese consumer stocks. And I think that people aren't really speaking about it enough. It will have. There are so many stocks that I see that will benefit from this. That they have basically suffered for 3 years now.
So let's dig into that first. I mean, there's a couple other rabbit holes I want to go down, but in terms of, we don't have to go into specific names unless you want to, but maybe the certain sectors that you do see that will gain the most benefit now, that you've seen that hadn't gotten much benefit in the last 3 years in terms of Chinese equities.
Yeah. So I think what I love about COVID-19 recovery stories is the fact that they're so simple, and we've seen this play out in so many other markets. What's going to happen, I think, is that people will get infected. There will be some type of herd immunity building. People will gain some immunity, and the subsequent waves will have less and less impact on consumer behavior. And just the fact that the restrictions have been taken away, like up to 250 million people were under lockdown, just a few months ago. So when that is taken away, I think people will start consuming. And specifically, when you're under lockdown, you probably buy your goods online, and you go less to restaurants, you go less to bars, and offline retail establishments are basically suffered. So those are the ones that would be the prime beneficiaries, just like in every other market. So when it comes to COVID-19, restaurants, bars, transport companies, like rail, toll roads, airports, and so on, they will do much better than before. And then you also have like the hotel industry. There are a bunch of them in Hong Kong, just listed stocks, as well as also anything to do with like online travel agents like Trip.com and this GDS called TravelSky. So those are basically the main beneficiaries. But I think just broadly speaking as well, sequentially, you're also going to see like a better economy, because household equity has been building for the past 3 years. Householders are doing pretty good because their spending has been lower than before, and so I think this will be positive for the entire economy. Of course, the picture is a little bit more complex than that because they've had a real estate bubble in China, and the export companies are suffering. But the consumer is stronger than ever, and I would, like I said, I would focus on these few sectors like hotels, transport, and restaurants, retail, basically, and
How
even
would you,
consumer.
for sure? But I mean, how would you say? Because look, I mean, I'm operating the microcap space. A lot of folks that are listening in here have either been burned or heard of someone been burned, or with regard to U.S. listed Chinese stocks, right? So there's always going to be some sort of risk profile when it comes to evaluating and looking at these potential investments, especially in microcaps. Let's be real. But in your opinion, has the risk profile changed? Have things become more risky? Is there things that folks should look at now a bit more intently?
Well, in terms of ADRs, I think that there is still a risk of delisting, and like US, the PCAOB, which I think is part of the SEC, they've been requiring audit papers from for Chinese ADRs, and I think we're moving towards a resolution of that problem, which means that these companies will stay listed as ADRs for the next 3 years, probably. So this delisting risk is probably decreased, most likely. I think we're not completely out of the woods in terms of that question, but I think the delisting risk has been weighing on these Chinese ADRs for the last year. So that's one part of it. And then, of course, over the past 2-3 years, Chinese tech stocks have been suffering due to a crackdown, I think, from the Communist Party, and that is a real challenge. The fact that China is a communist country, there is, and even more than that, it's kind of a country that's ruled by a Communist Party elite. That's been going after the opposition, and I think that's part of the reason why some of these companies have been suffering. Like Jack Ma, he might have posed too much of a threat to the top leadership in China, and I think that's part of the reason why Alibaba has been kind of restructured, and Jack Ma has basically been kicked out of it. There's been political games that have been affecting some of these companies, and also the fact that they've been operating in the media space. Like Weibo, for example, the Chinese version of Twitter, has been in some cases censoring content which the Communist Party did not like. So they've almost been a threat to the top leadership of the Communist Party, and therefore politically problematic. And that's not going away. You're still, this is still a risky country in terms of the lack of a rule of law and so on. And we've also seen that in the property sector with private developers really being cut off from bank financing, for example. Many of them are in the process of going bankrupt. So of course, China is a risky market to invest in. I'm just saying, like, cyclically, things have really changed over the past 2 months with zero COVID policy, with the border reopening, and this delisting risk pretty much most likely going away. And you can also sense that the Xi Jinping and the top leadership of the Communist Party are really trying to repair China's bad reputation in terms of its capital markets. So something changed, after October, after Xi Jinping gained a third term, and most likely it's positive from a cyclical point of view. And I think like if you're a stock picker, I think you would want to look into specific companies that will benefit, like, fundamentally, and make sure that the upside is big enough, because it is a very risky market. And then if you're an institutional investor, I think the big picture of like the macro story of China easing, both monetary policies easing, we can see that through credit is starting to flow again since October, and also the fact that COVID-19 policy is easing. Like, the macro picture is just so good. I don't think that people are gonna just neglect that. I mean, I think investors will start to pay attention to China again now that the rest of the world is kind of in a rate hike cycle and potentially entering into a recession.
Mm-hmm.
So I think a lot of investors will kind of hide out in Chinese stocks because the picture is just so much better from a top line point of view.
That's interesting you bring that up, because I mean, look, mostly in Western media, when China is being covered, other than, you know, the borders being completely closed, now they're being reopened, it has been its association potentially with you know, what's going on with Russia and Ukraine and the war there. You know, so it's that completely overshadows what's been, you know, now this it's almost like it's like, I mean, obviously it's been covered by most mainstream media as well, but I mean, at the end of the day, it seems to still not getting any kind of noise from a financial investing perspective, because even though it's reopened, there's still, it's like, okay, well, it may reopen, but there's still all these risks that are still associated with, on top of this big one.
Yeah. I mean, it's obviously a big risk. You know, there are threats. You know, every week there are planes just crossing the middle line between Taiwan and China, and that threat remains. But I think experts, they seem to think that some kind of more aggressive policy with regards to Taiwan could happen by 2027, maybe. Who knows, right? But I've also seen. I started investing in Chinese stocks, like personally in 2008 and also professionally in 2010. And I've seen so many cycles. They happen every 3 years. Like we had, like Hong Kong stocks were popular in 2010, Asia stocks 2015, and then we have Chinese tech stocks were hot in 2020, 21. But like it's a cyclical thing. And this is not the first time that I've seen this kind of negativity. Like I remember this 2013. I was at this Asia conference in southern China, in Hainan, and speaking to Chinese Asia investors, and they were so bearish, like so incredibly bearish. There was nothing positive at all in their view, and this really reminds me of that time. And maybe the narratives were correct in some ways, you know, like they were focusing on certain negatives, but this focus shifts throughout the cycle. And I think, you know, you just want, if you're a stock picker, just ignore this kind of broad macro narrative and just focus on the story, like of individual stock. And once people are really overweight, like they were overweight China, like they were in late 2020, that's the time to take, you know, to focus on the risk again, I think.
Absolutely. I mean, so I mean, when you're looking now, you know, now that you've recognized this cycle happening in the extreme bearish sentiment, or well, in your opinion, now the bullish sentiment in Chinese equity. I mean, what have been some of your criteria when you're evaluating potential investment in Chinese equities right now?
That's a good question. I mean, I'm personally like really cautious, and I've been, you know, over the past year, I've been frankly avoiding Chinese stocks because there's just a lack of rule of law, and I've been focusing on overseas equities that have exposure to the Chinese consumer. Like there's a Japanese condom maker called Okamoto, for example, and I mean, there are retailers, Japanese retailers, South Korean cosmetics companies that are selling into China. I feel more comfortable with them because they won't be zeros. I know that for sure. Whereas with the Chinese small caps, you often end up with you know, just maybe related party transactions, or you know, just there are many frauds out there, especially in microcap land when it comes to Chinese stocks. So I prefer to invest in Chinese stocks that have like proven product that you can identify, maybe that you've used yourself, and stick with those, because a lot of concept stocks listed, who, you know, in the US, they're there to just take your money and leave, and there's no repercussions for doing that. So just be aware of this strange incentive structure when it comes to Chinese ADRs. They're not interested in being there for the long term. So I'll be very, very cautious with Chinese microcaps in general, and stick with companies that have like really good products that you can see. I happen to own. I purchased shares recently in a Chinese company called Neo Technologies, which produces electric motorcycles. And that's a very risky stock, but at least they have a product that I know people like, and I'm aware of the risks. So so generally speaking, yeah, I will probably not get involved with Chinese microcaps that much because especially not um, those those run by promotion management teams. I prefer investing in SOEs generally, but if you have to, stick with those with really good products and good fundamentals.
Absolutely. And real quick for that one, the Japanese company that you mentioned, are you currently a shareholder?
I'm not, no, but
Okay.
it looks really, really cheap, and frankly, like uh, I'm going to say this many times, if you ask me with specific stocks, but frankly, the fundamentals look fantastic for Okamoto as well, because condom consumption, it's related to nightlife activity, and I think that's going to recover as well. After COVID peaks in the next few weeks, so that's really bullish. That picture's bullish, and yeah.
For sure. You're thinking outside the box, right? Like, oh, everyone's gonna go back to nightlife. Makes sense. So actually one last thing to wrap up our talk about China and the reopening there. And I think one thing, I mean, you said a lot of interesting things, but one thing that also stands out to me is like, look, if you want to look at China now that things are reopening, and especially on the consumer travel, that side of the business, it might be interesting to maybe assess and look at some companies that have exposure to that do currently sell in China, right? Like that, and they could be US, Canada based, they could be based outside of China. But if they have that exposure, look, it's reopening. People are going to have to use these things. So I think that sounds like the main message you want to put forward. Yeah,
Absolutely. I mean, okay, like just because like China doesn't have a clear rule of law and there are many frauds on unlisted Chinese stocks, like there are many ways to play this, just like you said, like overseas equities. There are also like American companies selling into China, Starbucks and Nike, whatever. So I think this should fit into your overall picture and the way that you make decisions. Also, with regards to multinationals.
absolutely. All right. So another question that I have for you, now again, with China's borders now reopening, Asia is a very big continent. To my knowledge, if I go back to fourth grade history, it's the biggest continent that we have on planet Earth, if I remember correctly. And many other countries that are also, make up Asia, and I also recently had Gautam Beda on the podcast where we talked about, he's starting up a fund specifically to invest in Indian equities. It's a U.S. fund to invest in Indian equities. And he talked about the opportunity with India. So I wanted to ask you from a broad perspective, looking at Asia, are there any other countries now that either look to benefit and or will not benefit with now the borders reopening? Considering India, all the other countries.
Yeah, I mean basically, East Asia is more exposed to exports to China than the rest of Asia. So let's start with Southeast Asia, where I'm based. I'm based in Singapore. So a lot of the countries here, they're producing commodities to a large extent. Countries like Indonesia, for example, and the industrial commodities are probably suffering from the implosion of China's property market. But so that picture is a little bit mixed, I think. It really depends on the specific commodity. But in East Asia, countries like or regions, like Taiwan and Korea, Japan, there you got many consumer companies. Like for example, in Taiwan, you've got a couple of like beverage manufacturers, instant noodles, so on. They are huge in China, and there are a number of them in South Korea as well, which have significant exposure to China. And then, like in Japan, there are many capital goods manufacturers, like machine tool makers, and those will probably get increased orders as well, presumably as factories reopen. And optimism returns. So basically, East Asia is where I would look first, and consumer companies. So Korea, Japan, Taiwan, and Hong Kong, of course. That's part of Greater China. There they're dependent on tourism, like the local Hong Kong companies that are serving. To a large extent, they're serving Chinese tourists, and that border has also opened up. It's going to open up on the 8th of January. So that's hugely positive for Hong Kong stocks in general, like local ones. So basically, those are the four countries that I would look at. Just being aware, that I'm talking about consumer stocks. I'm not talking about like tech companies or like DRAM memory chip stocks, anything like that. Because like consumer companies like the one I just mentioned, for example, Okamoto or like Uni President, and so.
Gotcha. So, you also you wrote another article that's it's unfortunately it's behind the paywall, so I have to ask you on here about it, to
Sure.
get what it is, and that's your 2023 predictions. I'm assuming
Sure.
that it's your 2023 predictions with regard to Asian markets. So, love to hear what some of them are.
Actually, okay. So in terms of those three predictions, I did that last year as well, just for fun, just to kind of set the tone a little bit for what I'm about to write in next year. And this year, frankly, my predictions were related to China, like the end of the zero COVID policy and the border reopening. That's very bullish on Chinese equities, and frankly for the region as well. That's one of those predictions. The other prediction is that I think deflation is going to come in the rest of the world. And, China is only one country in Asia, but for those companies that are selling into the US, for example, they might find it a little bit harder to with regards to consumer demand, because monetary policy is quite tight in the US. And if you get deflation, I think bond proxies will do really well, like long duration assets like US Treasuries, for example. And that's not an Asian asset, but I do think that like bond proxies like that, like utilities or consumer staples or high dividend stocks, would do quite well in a situation where just inflation comes down and bond yields compress as well, like interest rates go down as well. So that's one prediction, basically that bonds will do quite well in the rest of the world. And then I think once we get this pivot, once the Fed starts to ease again, if inflation comes down, comes below the 2% target, then you get some kind of pivot. And I think that will be the end of this long-term US dollar bull market. And I think once the US dollar starts to weaken, which probably already happened, if you look at long-term Dixie chart, it's kind of peaked. And once you get a down cycle in the US dollar, you will want to invest overseas. And I think that at this point, like if you want to make money, I would definitely look overseas as well, because if the US dollar starts to weaken again after this last year's 15-year bull market, foreign funds will start to outperform and flows will turn out again. So, I can tell you, even in this part of the world, last year, like early last year, everybody was investing in US stocks. And I spoke to a brokerage firm, here in Singapore, and they asked me, like, why do you want to invest in Southeast Asia? And I'm based in Southeast Asia. They didn't understand it. Like, they were pushing US stocks. So even here, foreign, like, people have been investing in US tech stocks and now suffering a bit of losses. And presumably the next bull market won't be in US stocks, but most likely in overseas equities, I would guess. So my prediction is basically there that the US dollar will start to weaken once the Fed pivot comes. And at that point, you will want to be invested overseas.
We've kind of already talked at length about, your opinion and your thoughts on the cyclicality of Chinese equities and, why, you're bullish on it. And despite all the main risks, which we did cover, What other countries in particular do you see that could potentially benefit from what you also see if potentially the dollar weakens and you start seeing outflows into overseas companies, particularly in Asia?
I think there are two main focuses here, and one is Chinese consumer stocks, and because the near-term fundamentals are just so positive, especially because of the end of the zero COVID policy. And then I would focus on Southeast Asian stocks, not just consumer stocks, but just generally. They're just so cheap, and I'm in awe whenever when I look at some of the companies that I personally own in Southeast Asia. I just don't understand why they're so cheap. The fundamentals are in many cases extremely good. You can get high quality growing compounders at below 10 times PE with good balance sheets. I'm talking net cash, which just doesn't make any sense at all. And I remember 10 years ago, this region was hot, and these stocks were all trading at 30 times PE or 40 times PE. So I've seen these cycles come and go, and I would guess, I don't know exactly when they will return, but Southeast Asia, markets like Indonesia, Malaysia, the Philippines, Singapore, are extremely cheap, across the board. And if you're a stock picker, you can even improve on the index returns, because just some of them are extremely cheap. Southeast Asia, there are many countries there. There are some exceptions, like Vietnam. Some stocks are a little bit expensive there. Thailand, some stocks are also a little bit expensive. India, same story there. Indian stocks are trading, especially consumer stocks, are trading at quite high levels. But Southeast Asia, maybe because there doesn't have a brand name factor. There's just no interest at all, and I keep mentioning my enthusiasm for them, but people just aren't interested yet. So we'll see whether that changes with a weakening US dollar. But at some point, if a company trades at P9 and it grows at 10% per year, at some point people will start to think, wow, this doesn't make any sense. Like, for example, I can mention a few examples just to make it more interesting. There's a chocolate manufacturer called Delphi, listed in Singapore. They have about 40% market share in Indonesia. Indonesia is it's a massive market. It's like 280 million people, right? And chocolate consumption is fairly low. It's minuscule compared to Japan or United States or even Europe. The discrepancy is even bigger. So there's secular growth there, and they have a 40% market share, 40, which is they're dominating the markets. And I think they have products which are quite modern as well, like that appeal to consumers. And I think the net cash to market cap is something like almost 30%. So the downside risk should be protected. The PE is somewhere about 9 times PE. Look at the last quarter revenues. They're up, I think it was over 20%. All like longer terms, I would expect growth rates close to 10%. But it's just a very stable company that's doing reasonably well. And I've dug deep into it, and of course the margins aren't as impressive as one of those Swiss chocolate manufacturers or the American ones. But still, this is one of the last remaining chocolate producers that remain independent from the multinationals. It's an asset that would be worth multiples, of the current market cap. It's about $300 million, I think. Listed in Singapore, so you can buy it via interactive brokers. So that's just one of those stories, but there are many, many more of them. Basically at similar valuations. And so Southeast Asia, Indonesia, Malaysia, Philippines, those countries, or Singapore, those countries I would definitely look into as well, other than this Chinese recovery story.
For sure. And real quick, are you currently a shareholder in the chocolate company?
Yes, I am.
Okay, cool. Just wanted to get that. So to close this out for the interview here today, when now you're seeing this opportunity, And assuming, let's say folks listen to this, we go viral. It's like, oh, let's just fly into, some of these Southeast Asian stocks and some of these consumer Chinese stocks. In your opinion, I mean, how long do you see this potentially happening for? You know how sometimes it's like, okay, you have the folks that found it a little bit early, maybe it's stayed flat forever, and then gets discovered. You see kind of that peak. I mean, what in your opinion, how does this cycle look to you compared to other cycles?
It's really tough. Like, I like to invest in value with a catalyst, where you have a identifiable catalyst. And that's why personally, I think if you want to maximize the IRR, you're probably better off investing in something like a Chinese recovery story, COVID-19 recovery story, because you know that the borders will open up in just a few days. And to me, that's a lot more interesting than just sitting on this Indonesian chocolate company, which has traded flat for almost 2 years now. Unfortunately, with microcaps, that often happens. You have to wait for quite a long time, and then suddenly things change. But so in terms of the IRR, it may not prove that interesting, but at least you're getting like 5% dividend yield or something like that, and while you wait, and eventually, I think it gets above that as the P ratio goes up, and also thanks to underlying growth of something like 10%. So I can't predict the markets. I can't predict like consumer behavior. Investor behavior. In this region, every time there's a tightening Fed policy, frankly, these markets have suffered. Like this time around, that effect hasn't been as pronounced, but it's a risk that if there's a recession in the United States, which I'm not predicting, but if there is, you often get outflows from these frontier markets like Indonesia, Pakistan. So I expect it to be cycles, and when in the next bull market, if we do get a weaker US dollar and people start claiming for risk assets again, that's the time I think when people will start paying attention again to Southeast Asian stocks.
All right. I think that's a great place to end it. Michael, where can our audience go and find more information about you as well as your newsletter, Asian Century Stocks?
Well, they can find me on Twitter. So my Twitter handle is Fritz, Fritz 844, or Z if you're American, Fritz 844. And my job is basically writing a Substack, and that's my full-time job. And the Substack name is AsianCenturyStocks.com. And I cover Asia Pacific stocks, including Australia and New Zealand. And yeah, we'll take it from there.
Perfect. Well, Michael, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Thank you so much.
This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.